These are the problems I was going to work in class, but didn't have time to on the balance sheet chapter. So these would have been the chapter 3 problems you did, but I didn't walk you through. What I want to note, of course, is that you can use a layout like this pretty effectively in terms of taking a trial balance, an adjusted trial balance, and then parsing it across what the common balance sheet subtotals are. And, of course, you might have to calculate equity on the test, but really, the big fallout happens between the assets that are classified in many different ways and then the liabilities as current and long term. So I'm just putting this up here for a key so that you can see it. And then I'll talk about how I parse this information apart. So the additional information is something that I typically go to first because it gives you that sort of updated disclosure on things. $22,000 of cash was set aside in a legally restricted fund to pay bonds payable that mature in 2024. Well, this classifies as the long-term investment. Remember, if this were a short-term legal need, if this were in 2017 that they matured, it would still be a current asset. We would just separately designate it as restricted cash. But because it's 2024, we put it as a long-term investment. And the cash surrender value of life insurance policy is a long-term investment as well. So both of these, the 22 and the 15, would end up as long-term investments, which the net of cash would then be a current asset. Looking at the accounts receivable, well, it says that some of these are owed by customers, so that is a traditional account receivable. The allowance for doubtfuls would be subtracted from this amount. And then we had some non-trade note receivables. And non-trades we'll talk more about them, but essentially a non-trade just means you're not doing it with your common customers. It's a different sort of receivable. They're due in 3 equal payments on June 25th over the next 3 years. Well, then we separate them into 3. If they're coming due in installments, each installment is $21,500. That means only the next installment of $21,500 would be current. This 43 would be a long-term investment. And then the interest receivable on a note due in 9 months. Well, that means we're going to collect it in the current operating cycle, so this would also be current. Therefore, the only thing we're going to break out from in the receivables as a long-term investment is this 43, which we put in there, and then the net of that amount, the net of 280, goes to current assets, which is, again, why this kind of works really nicely. You figure out what doesn't belong there, subtract it from the total, and then that's where you would put the rest for current assets, obviously. The prepaid expenses are $18,000 that will become consumed during 2017 and 14 and 2018, so we just separate them there and there. The 18, since it's going to be the next year, and then the 14 the year after is a deferred prepaid asset, and it would be an other asset. The investments are classified available for sale, includes an investment in 25 that matures in 2017. The remaining intends to hold for at least 3 years. So only one of them is coming due next year. The rest of them are going to be a long-term investment, 3 years. The land account includes land which costs $75,000 that the company purchased for speculative purposes and is currently held for sale. The remaining $100,000 is where we put our revenue-generating office building, and the equipment account includes idle machinery with a book value of $45,000. So with land, the speculative goes in long-term investments. The part that we do our operations on is PP&E because it's generating revenue. We said nothing about the buildings. So if you have no other information about the buildings, you assume PP&E. With the equipment, we heard that $45,000 is idle with a book value of 45. So again, we separate 45, and then the remainder, 100,000, is put under PP&E. We don't have any information on the payables except that we know, or the current liability counts, except that the unearned revenue represents prepayments. Subscriptions are for 5 years and will be earned evenly over each year. And so with the unearned revenue, then we divide that by 5, 30,000 per year. Well, only 30,000 will be a current liability. The remaining 120 will be earned in the long term. It will be an obligation we'll meet in the long term. The notes payable, I give you some information about. I said one's due in 6 months, so that would be a current liability without any other information, like we were going to refinance with a long-term liability. I would just assume it would be current. A $100,000 bond due in 8 years. Well, $100,000 in 8 years, that's certainly long-term. A $150,000 note in 6 annual installments of $25,000 each. The next installment is due November 1st. So 25 of this will be current, the rest long-term. So we have 100 long-term, 125 long-term. That means the 225 would be long-term, and the remainder 75, which is the 50,000 there. And the current maturity of this 150, 25,000 coming due on November 1st. Okay. And then you just total everything up. Makes it really nice and clean so that you can make sure you're showing all your totals. And it's always important to show me the components of what's going in here, because otherwise I can't give you partial credit for just, 356. And if that were off, I don't know what's off. I don't know what you miscalculated, right? But if you show me, these 4 things and only one of these was off, well, then I can give you at least, say 3 or 4 points, or, at least 3/4 of the credit for how much it is. Okay. Looking at the next one, this is more of these classification problems. $200,000 of bonds that will mature on 3/1/17. We have the ability and the intent to refinance it with a long-term debt that will be due in 5 years. And this is actually a current liability. I don't know why that says A. It should be F. F for $200,000. Sorry. It's not. I've had a long day. It's a long-term liability. It's G for $200,000 because it would be considered short-term if we were using cash. We're not. We're actually going to refinance it. So that's G, $200,000. 2-year prepaid rent for $240,000. I would say if there's 2 years remaining, then 120 would be for the next year, and then 120 for the year after that. So we'd have a current asset and another asset at 120 each. There's a patent that we purchased for $200 and has been amortized for a total of $40,000. That's an intangible asset, and we would value it at 160 less the amortization. Accounts receivable that have yet to be collected. So accounts receivable, they have 450, 80,000 have been deemed to be uncollectible. So that's our estimate of bad debts. 450 minus 80 would be 370. It would be a current asset. $450,000 of cash and cash equivalents, 125 of which is set aside as legally bound collateral for long-term debt. Since it's legally bound and it's long-term debt, then we would have a long-term investment of that amount, and then the net amount would be current asset cash. When you are discussing the various items that could arise in an annual report other than just the financial statements, I mean, you could talk about a lot of things, obviously. You could talk about the footnotes to the financial statements and how they give us more information, a full disclosure of all the items that are there, that they tell us about the significant accounting policies of the company, the choices that the firm makes with regard to their financial reporting, any subsequent events. So that's the footnotes you could talk about. The managerial discussion and analysis would be a place where management talks about their future plans for the firm, any kind of very unusual events that the firm has gone through that they would say you should not really put much weight on going forward, new issues of stock, new issues of bonds. The auditor's report would be another major one, obviously, where the auditor opines on the condition of the financial statements and their GAAP or non-GAAP nature. All right. So we looked at this one in class and we went through it, just again putting it up there for a key so that you can look at it. We also went through this guy in class, an adjusted trial balance that you were putting into balance sheet categories. And I don't have, we went through most of these. I, again, want to stress the importance of not just giving me the grand total, but showing me exactly what went into this number so I can give you as much partial credit as possible. It does balance out after Katie pointed out that I hadn't added the $150,000 of other assets to the total assets. After you add that number, it does balance out with total equity and total liabilities. So I didn't fail there. I just failed in including that 150. The one thing I didn't talk about was retained earnings. I start out with sales. So what I do first then is calculate net income. And that's net income because I also have tax expense in there. That would be my net income. I add in beginning retained earnings, subtract out dividends, and that gives me ending retained earnings. So, of course, the balance sheet would have retained earnings after we've made closing entries, and that's something to know. Something that some people got wrong. I remember once when I gave an example of this and asked them to give me a balance sheet. Well, they just took $92,500 as the amount of retained earnings on the balance sheet, and that's not correct. You have to adjust that $92,500 for all of the net income that is accrued during that time period, so closing out all these guys, and then also closing out dividends. So remember that. And then you simply take the ratios that you've calculated up here. It becomes rather simple once you have them. 897 is current assets divided by current liabilities of 290. The quick ratio, remember, is current assets that only include cash, marketable securities, and accounts receivable. So it's a more restrictive measure. In this case, it kicks out a couple, so we only have 597 after we take out inventory and prepaid assets, prepaid expenses. Total assets to total liabilities, again, pretty self-explanatory, and debt to equity ratio. I went ahead and calculated the ratios for Target, Cummins, and Alphabet, and those are the numbers that arise from there. The only one that was actually in any way tough, because most of these are readily laid out by the company, is Alphabet, which had some what they called receivables under reverse repurchase agreements. And a reverse repurchase agreement simply indicates that one firm sells another firm securities and then offers to buy them back at a later date. And Alphabet, having the asset end of that deal, had some receivables that were going to be, that arose from an agreement where someone was going to buy back things from them. I did not include that in the quick ratio simply because these are very highly stylized contracts that no other company would really be able to claim. Alphabet could sell them to a different company, but it would involve substantial discounts to that amount. And that's not something you would know off the bat. It's just something that I'm giving you some context for. But the rest were pretty easy because all these people laid out current assets, boom, right? Again, the quick ratio, exclude inventories, exclude prepaids. The only thing that goes in the quick ratio are cash, marketable securities, and accounts receivable, right? The short answer problems, one talks about different types of securities that we could have stock in many different forms. We could have common and preferred stock, treasury stock, short or long-term investments. What drives the difference between these methods of classification? Well, the shorter long-term investments are the equity stocks of other companies, not our company. These two represent the equity stocks of our company. Common and preferred stock is stock that we issue to stockholders. And remember, treasury stock is a stock that we have repurchased, our own stock repurchased from a stockholder. Right? So that one's not too bad. The non-controlling interest is a little bit more of a conceptual idea. And I said, remember that this account represents the amount of the subsidiary where the reporting unit, the reporting entity, owns a majority of the stock, but not all of the stock. And when that happens, so again, say that we own 70%, well, we still report 100% of assets and liabilities on the balance sheet when we do the consolidation for the majority ownership. So how do we make up for that? Because again, we don't own 100% of those assets and 100% of those liabilities. We only own 70%. Well, the way that we net it is by reporting an equity account called non-controlling interest. So, say that the subsidiary has assets of 100,000 and liabilities of 70,000, which means that their net assets, right, their equity is 30,000. Well, again, say that we own say that we own 70% of this firm. Well, the idea is that our company, the parent company, would report, even though they own 70%, they would still add $100,000 of assets and $70,000 of liabilities to their balance sheet, which would give them $30,000 of equity. But they don't have $30,000 of equity, right? And so what we would report then is 21. Just make sure my math is right again. It's been a really long day. I don't think I mentioned that already, but yeah. And so we would report as the parent 21K of equity, but that would have a 9K non-controlling interest because we do not own some of that, right? Well, where does that arise from? That arises from the idea that if we own 70%, this would be 70, that would be 30. That's what we own, that's what we don't own of that. And 70% of this would be 49 and then 21. And so we see now that the parent already reports this because they have assets and liabilities. So you don't even report that as equity. That's just their equity that they have from having 70%. This would be the amount that's reported. Okay, the 9K non-controlling interest. So if this would represent a credit in that account, the only way we'd have a debit in that account is if we had negative net assets. If the liabilities of the subsidiary were greater than the assets, then we would have a reverse of the situation, a negative non-controlling interest, and that would be a debit balance instead. Okay, so just a little bit of food for thought, kind of a way to wrap your head around things in a different way. And we will now look at the income statement problems here.